Welcome to the Deep Dive. Today we're tearing into the Humana third quarter 2025 earnings call. It happened pre-market November 5th.
Right. And this one really needs a closer look because you had this, disconnect, didn't you?
Exactly. The headline numbers look pretty good in one way, but the market reaction, totally different story.
That's the heart of it.
Yeah.
A solid adjusted earnings beat came in at $3.24 adjusted EPS, which, beat consensus by a good 41 cents.
Sounds great on the surface.
Yeah, but then bam, the stock drops. It fell, 5 to 7% right around the open?
So our job today is really to figure out why. Why did the market trade down so hard when that headline number looked like a win? We need to get past that beat and look at the details, the guidance, the whole message.
Precisely. It's about understanding the skepticism.
Okay, let's start with the basics. The Q3 results snapshot. Revenue was $32.65 billion.
Which was a slight beat, yeah. And good growth, too, over 11% year over year. So the top line itself wasn't really the issue.
No, but the earnings line. That's where it gets, complicated. There's this huge split between the different earnings numbers.
A massive disparity. You've got the non-GAAP, the adjusted EPS, that $3.24 figure. That's the one they beat on.
The good news number.
The good news number, exactly. But then you look at the GAAP EPS, the official accounting number,
Yeah.
and it was just $1.62.
Wow, that missed estimates by, nearly $3?
Around $2.86 short of consensus, yeah. A huge miss. And that difference, that signals there were some pretty significant, let's call them discrete items or charges hitting the books in the quarter.
Which always makes the street a bit jumpy, doesn't it? Questions about underlying quality.
It does. Even if the adjusted number looks okay, that gap noise creates uncertainty.
And what about the key metric, the insurance benefit ratio or the IBR?
That actually came in right where people expected, 91.1% for Q3. So operationally in the quarter itself, they seem to manage costs okay relative to expectations.
So Q3 itself wasn't the disaster. The beat was real unadjusted. IBR was in line. Why the sell-off then? It had to be about the future, right?
Absolutely. The market reaction wasn't about Q3 performance. It was entirely looking forward. It was driven by the guidance and what that implied about costs down the road.
Okay, so let's unpack that guidance. They did reaffirm one really critical number.
Yes, the big one. Full year 2025 adjusted EPS. They held the line at approximately $17.
That's their anchor, isn't it? The number they want investors focused on for the core business.
It's absolutely key to their narrative. It's management saying, look, despite the noise, the core profitability target is intact.
But, and it's a big but, that GAAP guidance got slashed.
Brutally cut. Full-year GAAP EPS guidance dropped to around $12.26. That's down sharply from their prior guidance of about $13.77.
Over $1.50 difference. Why? What did they say caused that?
They attributed it to, those discrete items again and mix effects. But when you see a cut that large, investors naturally start wondering what those discrete items really are. Is it restructuring? Is it write-downs? It just feels unsettling.
And then came the Q4 specific warning. This seemed to be the trigger for the immediate drop.
Yeah, the Q4 insurance benefit ratio forecast, they flagged it's expected to step up significantly.
How are we talking?
To around 93.5% for the fourth quarter.
Oof. That's a big jump from the 91.1% in Q3.
It is. Now, they say it's driven by normal seasonality. Q4 costs are usually higher, plus mix effects. But for a market already worried about high healthcare utilization trends across the whole sector,
seeing a 93.5% guide just ramps up the anxiety.
Exactly. It makes hitting that full-year IBR guidance range of 90.1% to 90.5% look really tight. There's not much room for error left in Q4. Execution becomes absolutely critical.
Hold on. Let me play devil's advocate. They cut the GAAP guidance significantly. They're forecasting a really high cost ratio for Q4. Why should anyone fully trust that $17 adjusted EPS reaffirmation? Isn't it possible they're just trying to put a brave face on things?
That is precisely the tension here. You hit the nail on the head. Believing the $17 requires a leap of faith in management's ability to execute perfectly in Q4 and beyond. You have to trust that those GAAP issues are truly one-off and that they can wrestle costs down despite that 93.5% forecast.
So it forces you to trust their internal controls and forecasting implicitly.
Right. But to be fair, they did offer some positive signs suggesting maybe things are stabilizing underneath the surface noise.
You mean the membership numbers? That was one brighter spot.
Correct. Their forecast for the full year individual Medicare Advantage net decline actually improved. They're now expecting around 425,000 net losses, which is better than the previous forecast of up to 500,000.
Okay, so fewer members leaving than they initially feared.
Yes. And while it seems like a small change, it's potentially a really important early signal. It suggests their retention efforts heading into the annual enrollment period, the AEP, might be starting to work. Maybe the plan changes and pricing adjustments are starting to stick better with existing members.
They also talked about finding savings elsewhere, didn't they? Operational efficiencies.
They did. They highlighted over $100 million in expected multi-year savings from various tactical cost programs.
Like what specifically?
Well, they mentioned outsourcing some finance functions, Genpact was named, and interestingly, deploying what they called agentic AI for call center support.
Using AI in the call centers. We're seeing that pop up more and more.
Yeah, it's part of a broader industry trend. Companies realize they can't just price their way out of cost pressures forever. They have to fundamentally improve efficiency. Getting that $100 million in savings would definitely help offset some of the insurance cost pressure down the line.
Okay, let's pivot from the immediate numbers and guidance to the bigger picture, the strategic story they're trying to tell.
Right, because management spent a lot of time on this. They kept emphasizing how their plan designs and pricing are meant to stabilize the economics of the Medicare Advantage business.
All aimed at that long-term goal, the 3% pre-tax margin for MA.
That 3% target is crucial. It signals a real shift in philosophy. They're moving away from, the growth at all costs approach that was common in MA for years. Now it's about sustainable, profitable membership, quality over just quantity.
And did they give any early signs from the current AEP enrollment period?
They did, though they stressed it's very early days, like only 2 weeks of incomplete data. But they said new sales were tracking at the high end of what they expected.
Okay, that's positive. Anything else?
Yeah, and this is important for that quality narrative. The channel mix looked better. They're getting more sales through their own internal distribution and digital channels rather than external brokers.
Why does that matter so much?
It ties directly into their focus on LTV and NPV customer lifetime value and net present value. The argument is that members acquired through their own channels cost less to acquire and tend to be more profitable over the long term. So optimizing that channel mix leads to higher value members, even if the total number isn't growing as fast.
Got it. So it's about maximizing the value of each member, not just the count. They also mentioned something about fewer plan-to-plan sales.
Yes, that means fewer existing Humana members are switching between different Humana plans. Reducing that internal turn is actually a really encouraging sign.
Oh, so?
It suggests members are more satisfied with their current plans, lower voluntary attrition, basically. It points towards stability in their core member base, which supports the whole stabilization story they're trying to tell.
Okay, now let's talk about the other big piece of the Humana story. CenterWell. That's their healthcare delivery arm, right? Primary care, pharmacy?
Exactly. And CenterWell is absolutely critical for their diversification strategy. It's meant to make them less dependent on the volatile quarterly swings of the insurance business.
So how is CenterWell doing?
Pretty well, actually. The primary care side showed really robust growth. They added, 56,600 patients in the quarter.
Wow, what's that as a percentage increase?
It's about 15% growth just compared to the end of last year, 2024. That kind of consistent double-digit growth in patient numbers is what really underpins the long-term value argument for the whole company.
And the pharmacy side, or other areas?
Pharmacy also looks strong. They called out specialty pharmacy and direct-to-consumer growth, and they're apparently exploring direct-to-employer pharmacy services too, which is interesting.
Expanding their reach. What about the government side, like Medicaid?
They outlined some pretty ambitious plans there for 2026. They're targeting higher margin, dual-eligible populations people eligible for both Medicare and Medicaid.
Which specific programs?
They mentioned a HIDE S&P in Michigan, a FIDE S&P in Illinois, and a dual-eligible Carvin in South Carolina.
Okay, Heidi, AFID, S&Ps. Break that down for us. Why are these dual-eligible plans potentially higher margin?
So dual eligibles are often patients with complex health needs. Managing their care is challenging, yes, but the payment structures for these specialized plans, like HIDE, highly integrated dual eligible, and FID, full integrated dual eligible special needs plans, are often more stable and predictable.
Because they allow for more integrated care.
Exactly. These plans let Humana, through CenterWell ideally, manage both the medical and the social or behavioral aspects of care much more closely. If you can do that efficiently, you can manage costs better and achieve more sustainable margins compared to standard MA plans. It's a move towards specialized integrated profit pools.
Makes sense. Now we have to address the elephant in the room that's caused problems before. Stars ratings. How do they address that?
They acknowledged disappointment, specifically with the results affecting bonus year 27 revenues, but they framed it as something they had already planned for, basically baked into their forecasts.
So no surprise impact on current guidance.
Apparently not. Their focus now is on improving for the future, specifically getting back to top quartile performance for bonus year 28. And they're trying to offer proof points, citing things like closing 600,000 more patient care gaps year over year compared to the previous year. Tangible operational improvements.
It sounds like everything circles back to that core idea they kept pushing, maximizing LTV and NPV across the whole company, insurance and CenterWell.
That's the strategic shift in a nutshell. It's not just about MA growth anymore. It's about building a stable, valuable enterprise where the parts reinforce each other. They seem willing to let go of lower value MA members if it means stabilizing margins and focusing on the members, and the CenterWell patients who drive long-term value.
Okay, so looking ahead, say over the next, I don't know, 6 to 10 weeks, what are the absolute key things investors should be watching?
I'd say three main things. First, any more updates on AEP? Are enrollment and retention trends continuing to support that LTV story?
Right, validation needed.
Second, and this is the big one, near term, Q4 execution. Can they actually hit or get very close to that 93.5% IBR target? That number is under intense scrutiny. Any miss there will likely hit the stock again.
The immediate battleground.
Definitely. And third, just continued strong performance from CenterWell, especially that primary care patient growth. Keeping that momentum going is crucial for the diversification narrative.
So the big picture really is, they reaffirmed the $70 adjusted EPS target, which could support a stock recovery into 2026. If they stabilize that benefit ratio along the lines they guided, and if investors are willing to look past the short-term JAP noise and trust the Q4 execution.
Right now, the market's voting with its feet, isn't it? It's selling the risk. It's choosing to focus on the Q4 cost execution challenge rather than the $17 promise or the longer-term CenterWell story.
Okay, you're listening to The Deep Dive. And now it's time for our segment. This is not financial advice. Remember, we're just exploring ideas based on the earnings data and market reaction, not recommending any specific trades.
Absolutely. Purely illustrative. So, given the market's immediate negative reaction, dropping the stock 5-7% based almost entirely on that Q4 IBR guidance.
That 93.5% number.
Yeah, that specific number. It tells you the market is extremely sensitive to near-term cost trends right now. So you could construct a trade idea around that specific anxiety.
How would that work? What kind of idea?
Well, you could consider a short-term volatility bet, something that profits if the skepticism lingers or if they actually do struggle to hit that Q4 target. You'd want to target the period before the Q4 results actually come out next year.
So betting on continued doubt or a potential miss, what kind of structure?
A defined risk strategy might make sense, like a bear put spread. You'd buy a put option at one strike price and simultaneously sell another put option at a lower strike price, both with the same expiration date, likely before the Q4 earnings release.
And the logic behind that specific trade?
The rationale is pretty straightforward. It plays on the idea that maybe healthcare utilization will remain stickier and higher than even Humana's 93.5% forecast implies. If that happens, or even if the market fears it will happen as Q4 progresses, there could be further downward pressure or at least heightened volatility around the stock as we get closer to seeing the actual Q4 numbers.
So it capitalizes on the market's laser focus on that Q4 IBR execution risk, regardless of management's confidence in the full year $17 adjusted number.
Exactly. It isolates that specific near-term fear. It's a sentiment play, really, betting that the anxiety around the cost ratio will outweigh the longer-term story, at least for the next few months.
Okay, so wrapping this up. For you, the listener, what's the core takeaway here? We saw a quarter where, yes, the adjusted earnings beat was strong.
But it was completely overshadowed.
Completely by worries about that Q4 cost ratio stepping up and that big cut to the GAAP guidance. It really forced investors into a tough spot.
Yeah, you basically have to decide. Do you believe in the long-term story, the CenterWell growth, the LTV focus, the path back to stable margins, or are you more worried about the immediate execution risk on costs in Q4?
That seems to be the debate the market is having right now.
And maybe the provocative thought to leave you with is this. If CenterWell keeps putting up those strong double-digit growth numbers quarter after quarter, does the market eventually have to start putting less weight on the quarterly noise from the insurance IBR?
Will the growing stability and value of CenterWell start to outweigh the inherent volatility of the MA insurance cycle?
That's the question. How much does consistent delivery growth offset insurance fluctuations in the overall valuation? Something to think about.
Indeed. That's the challenge for all these integrated players. Thanks for joining us for the deep dive. We'll be back soon to unpack another set of sources.